I still remember the first time I witnessed a flash crash in real time. It wasn't dramatic at first, no breaking news banner, no screaming headlines, just a quiet, almost polite movement on the chart. Price dipped a little faster than usual, spreads widened, and for a split second my brain told me, this is nothing, just noise. Then the market vanished. Liquidity disappeared like someone had pulled the plug on reality itself. Candles fell vertically. Stops were triggered at prices that never truly existed. Orders filled far away from where logic said they should. And by the time my eyes caught up with what was happening, the damage was already done. That was the moment I learned a brutal truth most retail traders discover too late. The most violent moments in markets don't announce themselves. They arrive silently, finish their work in seconds, and leave nothing behind but disbelief. When people talk about flash crashes, they usually treat them as rare accidents, glitches, technical errors, one-in-a-lifetime events. But after 15 years in the markets, I've learned something uncomfortable. Flash crashes aren't anomalies. They're pressure releases. They are what happens when fear, leverage, and thin liquidity collide faster than the human nervous system can react. And if you're a retail trader, you're never standing on the right side of that collision by accident. In this video, I want to take you through the most brutal flash crashes in market history, not as a list, not as trivia, but as moments where the market showed its true nature, cold, mechanical, and completely indifferent to belief, confidence, or experience. Because if you've ever said that would never happen again, you're exactly the person the next flash crash is waiting for. The night I truly understood flash crashes didn't happen during a famous one. It happened during a quiet session in a market that everyone believed was stable. I was trading confidently back then, not recklessly, but comfortably. I trusted my stops. I trusted liquidity. I trusted the idea that even in fast markets, there would always be buyers and sellers somewhere close enough to protect me. That belief came from textbooks, from charts drawn after the fact, from the illusion that markets move in orderly steps. Then, one night, price jumped, not down a trend, not through levels, but straight through space. My stop didn't trigger where I placed it. It triggered where liquidity still existed. And that difference cost more than money. It shattered a mental model I didn't even know I was relying on. I remember staring at the screen afterward, not angry, not panicked, just confused. I had done everything right. Risk was controlled, position size was reasonable, the setup was valid, and yet the market had simply ignored me. That confusion is the same feeling traders experienced during the most infamous flash crashes in history. The Swiss Franc in 2015, the Dow Jones in 2010, gold, oil, crypto, markets that were considered deep, liquid, and resilient until the exact moment they weren't. What ties all of these events together isn't technology or news, it's a misunderstanding of how markets behave under stress. Retail traders think price moves because of information. In reality, during flash crashes, price moves because of absence. Absence of liquidity, absence of counterparties, absence of mercy. And the most dangerous part is this. Right before a flash crash, everything often looks calm. That calm is what kills accounts. Because when volatility compresses, when markets go quiet, traders get comfortable. Leverage increases, stops tighten, algorithms line up on the same levels, liquidity pools form where everyone feels safe. And safety in markets is usually where the trap is deepest. I've seen traders survive years of bad decisions only to be wiped out in seconds by a single flash crash, not because they were careless, but because they didn't understand the kind of risk that doesn't show up on a risk-reward calculator. Flash crashes don't punish ignorance, they punish certainty. They punish the belief that markets owe you continuity, that price will move smoothly, that there will always be time to react. History shows otherwise, repeatedly, brutally. And if you're still trading today, the only real question is not whether another flash crash will happen, but whether you'll recognize the conditions that make it inevitable. What makes flash crashes so terrifying isn't the speed. It's the way they expose a lie most traders don't realize they're living with. The lie is that markets are continuous, that between one price and the next there is always someone willing to trade with you, that charts represent reality. They don't. Charts are memories. Flash crashes are reality. The first time the world truly saw this was on May 6, 2010. The Dow Jones Industrial Average fell nearly 1,000 points in minutes. Blue-chip stocks, companies people considered untouchable, traded for pennies. Accenture printed at 1 cent. Procter & Gamble lost nearly 40% in seconds. Then, just as quickly, much of it reversed. From the outside, it looked like a bad dream. From the inside, it felt like the market had briefly stopped obeying the laws it had followed for decades. But nothing broke, nothing malfunctioned. Liquidity simply stepped aside. High-frequency algorithms detected instability and pulled orders. Market makers widened spreads or vanished entirely. What remained was a vacuum, and price fell until it found something solid enough to stop it. Retail traders watching from home thought it was chaos. Institutions watching from inside knew exactly what it was. A reminder of who controls the exits. 5 years later, another lesson arrived, this time in the foreign exchange market, where liquidity was supposed to be endless. January 15, 2015. The Swiss National Bank removed the EUR-CHF floor without warning. In theory, this was just a policy change. In reality, it was an earthquake. The Swiss franc surged thousands of pips in minutes. Stops were skipped. Brokers went bankrupt. Traders didn't just lose their accounts, they owed money. I remember reading messages from traders who had gone to bed confident, properly hedged, conservative by every definition they knew. They woke up bankrupt. What struck me wasn't the magnitude of the move, it was the reaction afterward. People searched desperately for someone to blame, the SNB, the brokers, the platforms. But the market hadn't betrayed anyone. It had simply revealed the truth. During stress, price doesn't move through levels, it jumps between liquidity islands. And if you're standing on the wrong island, no stop loss can save you. By the time crypto arrived, the lesson should have been learned. Instead, it was amplified. Crypto markets made flash crashes feel personal. Brutal wicks, overnight collapses, exchanges freezing while price moved wildly elsewhere, accounts liquidated on candles that existed for seconds. In March 2020, Bitcoin dropped nearly 50% in a single day. On some exchanges, it was worse. Liquidations cascaded, margin calls fed more selling, and liquidity disappeared faster than most traders could log in. I watched experienced traders, people who had survived multiple cycles, get wiped out not because they were right about direction, but because they underestimated how quickly structure can collapse. Flash crashes don't ask whether you were right, they ask whether you were exposed. That's the part no one wants to hear. Here's the uncomfortable revelation most traders avoid until it's too late. Flash crashes are not extreme versions of normal market behavior. They are a different state entirely. In normal conditions, markets negotiate. Buyers and sellers argue over price. Volume flows back and forth. Time exists. In a flash crash, negotiation ends. The market switches modes. Preservation replaces price discovery. Participants don't care about value, they care about survival. Algorithms shut down, market makers step away, risk managers hit kill switches, and price falls until fear finds a bottom. Retail traders, meanwhile, are still playing the old game. They're waiting for confirmations, for bounces, for logic. There is no logic in a vacuum. The real mistake most traders make isn't using leverage, or placing tight stops, or trading volatile instruments. The real mistake is assuming that tomorrow will behave like yesterday.
Flash crashes happen when systems are stretched, when confidence is high, when positioning is crowded, and when liquidity is thinner than it appears. They happen when too many people believe they're safe. That's why they feel so unfair. And that's why they're so effective.
What flash crashes really teach us isn't about speed, it's about structure. Most retail traders think markets move because of information, news, earnings, macro events, tweets. That belief feels reasonable because information is what we can see. But flash crashes don't begin with information, they begin with positioning. Long before price collapses, the market is quietly loading risk onto one side of the boat. Leverage increases because volatility feels low. Stops cluster because technical levels look obvious. Algorithms align because models are trained on the same historical assumptions. Liquidity appears deep because no one is testing it. This is the illusion. Liquidity is not volume. Liquidity is willingness. And willingness disappears the moment risk feels asymmetric. In normal conditions, price moves because buyers and sellers negotiate. In a flash crash, that negotiation stops. One side withdraws completely, and the other is left shouting into empty space. This is why flash crashes feel vertical. Price isn't moving faster, it's falling through absence. You can see this clearly in every major flash crash if you look past the headline. In 2010, it wasn't a rogue trade that caused the Dow to collapse. It was the sudden evaporation of market makers once volatility thresholds were breached. When protection systems triggered, bids vanished. Price didn't fall because people sold. It fell because no one was willing to buy. In 2015, the Swiss franc didn't explode upward because demand suddenly surged. It jumped because the floor that anchored expectations disappeared, and with it, the liquidity that relied on that anchor. Banks stopped quoting, brokers stopped filling, price leapt between what little liquidity remained. In crypto, the mechanism is even brutal. Liquidation engines are programmed to sell at any price once margin thresholds are crossed. That selling pushes price lower, triggering more liquidations, which creates more selling. Liquidity thins, spreads widen, and suddenly a candle exists that no human could trade inside. This isn't chaos, it's automation doing exactly what it was designed to do: protect capital at the system level, not at the individual level. And this is where smart money thinking diverges completely from retail thinking. Institutions don't ask, where will price go? They ask, where will liquidity fail? They don't place stops where charts look clean. They reduce exposure when markets feel calm. They treat low volatility as risk, not safety. They assume that exits may not exist when they're most needed. Retail traders do the opposite. They increase size when things feel stable. They tighten stops when price slows down. They add leverage when confidence rises. Flash crashes punish that behavior with precision. There's a case I often return to because it illustrates this perfectly. During the March 2020 crash, many professional funds were already de-risking before price collapsed, not because they predicted a pandemic outcome, but because volatility structures were breaking, correlations were spiking, liquidity was thinning across asset classes simultaneously. Retail traders, meanwhile, were buying dips aggressively. This can't go lower. The Fed will step in. This is an overreaction. They were right, eventually, but timing is everything when liquidity disappears. Those who survived weren't the ones who guessed direction correctly. They were the ones who stayed small enough to remain flexible. That's the insight most traders resist. Survival precedes profitability. Flash crashes don't select victims randomly. They select based on exposure, leverage, and dependency on continuous liquidity. If your strategy requires smooth price movement, flash crashes are existential threats. If your risk model assumes fills at specific levels, flash crashes invalidate the model. If your confidence comes from backtests that never include liquidity gaps, flash crashes expose the fantasy. And here's the hardest part to accept. None of this is abnormal. Markets are complex adaptive systems. They don't fail gracefully, they snap.
Flash crashes are not errors, they are stress responses. When pressure builds silently, release is violent. Once you understand that, your relationship with the market changes. You stop asking how to avoid flash crashes. You start asking how to remain alive when they happen. That shift, from prediction to resilience, is the line between traders who last and traders who disappear.
If flash crashes are inevitable, then the real question isn't how to predict them, it's how to be positioned when they arrive. Most retail traders approach risk as a number, a percentage. 1% per trade, 2% per idea. That works in normal conditions when markets behave like the charts suggest they should. But flash crashes don't care about percentages, they care about fragility. The first shift that has to happen is psychological. You stop assuming that your stop loss is protection. In a flash crash, a stop is just a request. It will be honored only if someone on the other side is willing to take it. When liquidity disappears, stops don't fail because of bad luck. They fail because the structure they rely on is gone. That means position sizing has to be conservative enough to survive slippage you cannot model. Not small because you're afraid, but small because you're realistic. If losing more than expected would break you emotionally or financially, the position was already too big. The second shift is understanding exposure, not just direction. Flash crashes punish concentration. Too much size in one instrument, one exchange, one broker, one idea. Smart traders don't ask, is this a good trade? They ask, if this market stops functioning for 5 minutes, what happens to me? That question changes everything. Diversifying isn't about owning many things, it's about not being dependent on a single point of failure. One exchange freezing, one currency repricing, one algorithm pulling liquidity. When you reduce dependency, you reduce existential risk. The third shift is learning to respect quiet markets. Low volatility feels safe, but it's often when risk is being stored. Tight ranges, compressed spreads, predictable price action. These are the conditions where leverage quietly builds across the system. When the release comes, it's fast, because everyone is leaning the same way. Experienced traders reduce risk when things feel easy, not because they expect a crash tomorrow, but because they know calm is when exits are most fragile. Finally, there's humility. Flash crashes remind us that markets don't owe us continuity, fairness, or time to react. They don't reward intelligence or experience during stress. They reward robustness. The traders who survive aren't the ones with the best predictions. They're the ones who can still make decisions after something breaks. The lesson in all of this is simple but not comfortable. Markets are designed to be kind. They are designed to function. And sometimes, functioning means clearing excess risk in the most efficient way possible, violently. Flash crashes are the market's way of reminding us that certainty is borrowed and liquidity is conditional. If you trade long enough, you won't avoid them. You'll live through them. And when you do, what matters isn't how smart you were before the crash, it's how exposed you were when it happened. The goal isn't to be fearless, it's to be unbreakable. That's what mastering the markets really means. Not winning every trade, not predicting every move, but staying alive long enough to let probability work in your favor. If this video changed how you think about risk, liquidity, or certainty, let me know in the comments. I read them. And if you want to keep going deeper into how markets really work beneath the surface, subscribe to the channel. This is Staro Trading. Master yourself, master the markets.